Welcome to the Remarkable Retail Podcast, Season 3, Episode 8. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, Steve, great to be back on the mic with you again now. Once again, to remind our listeners and viewers that we're now weekly. So this is great. We get to catch up. So much is happening. We got so much to talk about. We got great guests. And speaking of great guests, we have an amazing guest in this episode, Daniel McCarthy, Assistant Professor of Marketing at Emory University, Goizueta Business School out of Wharton. He came out of Wharton with more degrees than a thermometer, this guy. How did you get to know Dan, or how did you come across him?
It was kind of a two-step process. I've been interested, because I'm a geek like that, in the unit economics of some of these digitally native vertical brands. And I ran into an article that was dissecting the meal service, Blue Apron's cost of customer acquisition and retention and all these kinds of things. And it was a tour de force that this guy had kind of backed into from public data. And I thought it was really fascinating. I didn't pay much attention to who had written it. And then, I don't know, a year later or something, I was talking to Peter Fader from Wharton, and he mentioned this PhD student of his, Dan McCarthy, and he said, oh, he did this Blue Apron thing, and he's doing all this interesting analysis on customer lifetime value. And I'm like, wait a minute, that's the guy. And so anyway, then we've subsequently had several conversations, and I've been following his work for, I guess, about the last 3 years, something like that. So good guy, really unique perspective.
Yeah, it's a great discussion, and we'll get to that a bit later. But let's jump into news of the week. So as is the case in many of our episodes, let's start talking about Amazon. A couple of things on the go there. Televisions, tuition, and hiring. So speak to what you heard about all three of those.
Well, not too surprisingly, Amazon announced they're going to be doing their own private brand TV. It's just a continuation of this strategy of developing their own products. I think this is maybe the first step into some bigger ticket items, higher dollar items where they can have great technology and an attractive price point and use it to target. So who knows? Maybe eventually they'll be coming out with the Amazon car or Amazon refrigerator or whatever. But televisions. And then, as we seem to have just about every week, we've got news of Amazon's hiring. They announced 125,000 new jobs in the U.S. on top of what we talked about, I think, a couple of weeks ago about these technology jobs and administrative jobs they're adding, raising their wages, offering tuition to some of their players. So I think, or some of their team members. So, it's just part of this hiring crunch that I think is going on where, it's just a war for talent and people have to, or retailers have to keep kind of upping the ante to be able to keep and retain people.
In Canada as well, they announced 15,000 new hires. Now, we should refer our listeners back to our interview with Brad Stone, who wrote such great books on Amazon. And he makes the point that, well, yes, at the warehouse level anyway, they have, in some ways, on purpose, tremendous turnover. So It's not a net number, right? I mean, I can't remember if he told us a percentage. Listen, in some mass merchants, you're 50% turnover at the store floor. So let's assume it's double digits. You're not really hiring that many people. You're replenishing to some degree, right?
Certainly, if you look at their overall growth, they keep just adding huge numbers,
undeniably,
more distribution centers, you name it. But it's not a net number. That would be a lot more helpful if they would quote that occasionally.
Let's move on to NPD. So put out a report talking about consumers still spending more per trip, which is interesting, right? Because we knew that was happening in the COVID era. I want to go less. I'm going to have bigger baskets, but yet there seems to be, and I'm not sure. I'd love to hear your opinion. Is this a change in consumer behavior, or are we still in the pandemic era enough that people haven't quite got back to their normal behavior? What do you think?
Well, I'll give you a bold, I'm not sure. It is a bit surprising to me for the reasons you mentioned. We've still got this dynamic of certain parts of the U.S. for sure, where there aren't a lot of people vaccinated, relatively speaking, and there does seem to be some pullback from going out. So it could be mostly a COVID phenomenon. But at the same time, a lot of the folks like Walmart and Target and others that benefited from this consolidation. Maybe more people just said, you know what, this is just more convenient to go get a lot of stuff all at the same place. I don't necessarily have to go to three or four places. So I don't know. I expected it to revert more back to where we were before. But with the tick up in COVID, maybe that's still kind of an overhang. But, if you look at the spending numbers for the past month that were released earlier this week, overall consumer spending in the U.S. was up 20% on a 2-year basis. So that's very, very robust. So, it seems like just about everybody is spending a lot more money. So how much that factors into this distribution, I don't know. But certainly at this point, the consumer is out there spending money.
I was trying to unpack those numbers a bit because we're trying to do the same thing here in Canada. And this was my week, or last week was my time to talk to all the many, many executives I talked to create a report every quarter for Retail Council of Canada. And a couple of observations came out about numbers like that. One, there's some inflationary pricing baked into some of those numbers. So we are now seeing in Canada, the number came out highest inflation number in 18 years. I see 4.5% in the U.S. So, the sales numbers, I think there's inflationary pressures baked in. I think there's also unintentional upselling. So I'll give you an example. So I wanted to get a printer for my daughter, and she wanted a laser color printer, which is, not your cheap and cheerful one. And I found a nice one online from reviews that was about $375 Canadian. Well, I went to Staples. It didn't exist. It's gone. Like, they have no inventory. And then I checked everywhere. There's no inventory anywhere. So I wound up buying a $700 unit. And why did I buy a $700 unit? Talking to the retailers, they're like, there's a shortage of a lot of stuff from chips and that. And they're saying we are seeing some choices made at the store shelf, so to speak, or virtual shelf, that really I'm substituting. And I'm substituting up, not down.
Right. More likely to do that.
Because that's all there is. Let's talk about Casper. So our friends at Casper have been on a wild, wild ride, but that ride seems to be, for some of them, over. They're making some big changes that don't look so positive. Right?
Yeah. Casper's it's been an interesting business. They were really one of the first kind of breakout digitally native vertical brands, that got to $100 million pretty quickly. They were one of the first to go public and had talked about opening as many as 800 stores, which I thought when they announced that was pretty crazy, but it doesn't look like they're even going to get to 80. It's a business that has just struggled to make money. They laid off a bunch of C-suite people last week, or in the last week, reduced a bunch of people at headquarters. And so, it's really a brand that I think has been more hype than substance. Gross margins have been challenging the entire time. They've spent a ton on marketing, really created a business that looks to be pretty profit-proof. And it's particularly interesting now. There's a lot of competition, but you would think with the effects of COVID, with more traffic going online without having to pay for it, and with the home industry on fire, this would be a time where they'd be lighting it up. But I think some of their spending and just sheer competition has caught up with them.
Let's talk about Walmart. They announced 32 million plus their Walmart Plus program, 32 million members, and they've ebbed and flowed on a Prime-like Plus program loyalty thing with benefits for years. They seem to have, with 32 million people, they seem to have nailed something here. What are you thinking about their program and its relative success?
I suppose you could look at this as glass is half full or glass is half empty. Glass is half empty is they're way, way short of where Prime is. Prime, I think in the U.S. is 160, 175 million members or something like that. So they've got a long way to go if the goal is to kind of level up against Prime. But 32 million is a very sizable number. And
population of Canada, by the way.
Yeah. So
our population of this country.
Yeah. And it's happened in a relatively short amount of time. Gives them a lot of data, much more of a one-to-one relationship with customers in addition to the Prime-like benefits, at least on the delivery side. So I think it's impressive.
So I guess you're getting ready to make you and your former colleagues at Sears getting ready to make a pilgrimage to a store in Illinois. I'm sure it's an emotional moment for you. Sears is closing their last.
Tissues here someplace.
Sears closing its final Illinois store, as you've described it many times, which is kind of in and of itself a tautology, the longest liquidation sale in retail history. What are your thoughts?
Well, every once in a while, I get messages from people who say, "Wait, Sears still has stores?" I think a lot of people think that Sears shut their doors several years ago. I think they're down to like 40 or 50 Sears stores and roughly similar number of Kmart stores. But yeah, the Woodfield Mall store, it's Schaumburg, Illinois, actually opened 50 years ago. And it is the store that was closest to the Sears headquarters. So when I lived in Chicago and I worked for Sears all these years ago, that was the store
Sears Tower.
I was in the most. And that was where we tested a lot of things. And the Woodfield Mall is a huge, huge mall. I don't know where it ranks in terms of sales revenue in the U.S. It's got to be a top 30, top 40 mall. So, it's kind of an end of an era for a company that, started in Chicago, has been based in Chicago all this time, to not have any stores in the state of Illinois. It's quite remarkable, really, so in a bad way. So, yeah, I mean, it just sort of begs the question when you can't have a store like Woodfield be productive. How much longer are these several dozen stores going to be around? So, it's just Weekend at Bernie's, just dragging the corpse around a little bit longer, I guess.
If you're listening to this on our podcast, thank you, first of all. Lots of people are, and be sure and leave us a review because that helps us get to more people. We also have a YouTube channel. And on that YouTube channel, it's our conversation, but there's we call it bonus content, because you and I talk about the news of the day for longer than we put on to the podcast, just for length. So there's lots of fun extra bonus content on our YouTube channel. So be sure and tune in. Daniel McCarthy is our guest, and he really is fascinating discussion. So without further ado, let's get to it.
Well, Michael and I are delighted to welcome Dan McCarthy to the podcast. And Dan, rather than us trying to do an introduction for you, we would love to have the guests just tell us a little bit about themselves and their professional journey, and then we'll jump into some of the more substantive questions.
Yeah, sounds great. So, I'm an assistant professor of marketing at Emory University. My main area of focus is really predicting what customers will do and then translating that into implications for the health of firms, typically. The other hat that I wear is not as an academic, but as an entrepreneur. I've co-founded a business called Theta Equity Partners. We basically use these same sort of predictive models for customers, but we use it to help understand, how healthy are these businesses? If you're a private equity firm or a hedge fund or a venture capital firm, and you're looking at that latest company that has come on your plate, we'll basically help you understand the unit economic health of the firm and how all that rolls up into overall valuation. So, it's basically the topic of my PhD dissertation, which is customer-based corporate valuation. So that's about where I am. In terms of where I've been, I'd actually had co-founded a prior business called Zodiac that, again, used these same sort of customer models. I'm basically a one-trick pony, but I really like that one trick. But at Zodiac, we basically use the models to help marketers make customer acquisition retention decisions. So, again, same models, different use case. We grew the business and sold it to Nike in March of 2018 before founding Theta. So, that's basically a little bit about me.
Can you just kind of at the very high level help us understand what this idea of customer corporate-based valuation is, and just some of the fundamental principles of customer lifetime value and some of the other techniques you use that would be different than maybe way things people might be familiar with or have used in their jobs?
Blue Apron is a really good example of how the framework can be useful. Basically, these days, more often than not, companies are going public, and they kind of have two main characteristics. They're growing really quickly, and they're losing money. And the big question is, which of those businesses is actually going to hold value over the long term? And so one of the big questions, first off, is there a path to profitability? And if so, how quickly are they going to get there? And I view this as basically a way to really nicely answer that question. And the reason why is because when we think about basically what drives operating leverage over time, it's the ability to make more money after you've acquired a customer than how much you spent when you brought that customer in the first place. And a lot of these businesses that we'll look at, they'll have to basically expense all of the money that they're spending to acquire customers today. And they're going to get this value from those customers into the future. And so the big question is, well, how long into the future is that going to be? And how much profit is that going to bring? If you have a business that doesn't have a whole lot of repeat buying behavior and they don't make a whole lot of profit off those purchases, you spend all that money up front and you're not going to get a whole lot in the back end. Conversely, if you had another business that did a lot of repeat purchasing, actually their historical profitability may look similar to that first company, but we can see that over the long run, they should be able to compound revenue growth much more easily. And those repeat orders are probably a lot more profitable than the initial one that you had spent all that money to bring the customer in the first place. So CBCV in some ways is just kind of a way to formalize all that. And it kind of recognizes this basic accounting identity that all the revenue has to come from customers. And so if we just have a formal model that lays out, this is the flow of customer acquisitions over time. This is how long they'll stay after they've been acquired, order frequency, basket size, and then the profitability of those orders. It allows us to basically do the same thing that the bankers probably had been doing before, but we can do it more accurately because we have this diagnostic set of best-in-class marketing science models to make the predictions. And we get for free that look at the underlying unit economic health of the firm as viewed through the customer lifetime value, customer acquisition cost framework.
Let's pull on a couple of threads in that narrative. First of all, how did you come to build or have this perspective? What in your background led you to this model? Did you try other models and find them unfulfilling and unpredictive, or what is it that led you to develop and focus in this area of expertise?
It's a good question because I probably wouldn't have been so interested in this if I didn't spend 6 years working at a hedge fund. So actually before all of before the PhD, before Zodiac and all that, I'd been on the buy side working for a fundamental investment fund. And we basically looked at a lot of businesses and did kind of the traditional thing where you roll up the sleeves, you speak to the management team, you look at the competitive dynamics in the industry, and then you build out some really big spreadsheet.
A little SWOT analysis thrown in maybe for a good PowerPoint slide. And especially with the people that I work with, they were former McKinsey consultants, and so they did a lot of that sort of thing. And so I kind of had this predisposition towards valuation. When I went to Wharton, I finished with a PhD in statistics, not even in marketing. But in the second year of the program, someone said, you should really speak with this guy, Pete Fader, who, Steve, you were mentioning. And we really kicked it off. But I really don't think that if I didn't have both the hedge fund background and, I wasn't going for a statistics PhD, this wouldn't have been a natural step at all. It was really the fact that, I'm just like a prediction guy who happened to have worked at a hedge fund for a while. That's kind of what led me to it. You could ask the next question in kind of a funny way. Why would anybody look any other way at companies? I mean, when I think about, Steve and I talk about this often on the podcast when these results come out and the market is like, gobsmacked at these great results or disappointed. I mean, some of these things seem maybe obvious, and the way that they've been looking at companies, it seems, hasn't changed. Why do people not adopt what seems to be a very, how much money are you going to make, and unit economics still matters? Is it like Aswath talks about it at Stern, story stock versus a performance stock? Like, give me a broader context about why this model is not the model that uniformly is we see in the media, for example.
So first, I think that 10 years from now, it is going to be the model. So I think we're getting there. I think the reason why we haven't seen it yet has been first, just that it's impossible to do sometimes. And there's a few reasons why. One would be when we think about a company like Nordstrom, or J.C. Penney, they spent most of their existence selling through stores, and oftentimes the customers making the purchases bought in cash, and they may not have had a great CRM system. And if they don't have, basically, if you're kind of even somewhat similar to those examples, you won't actually even know how many customers you have. And so when you think about, well, what is my CAC? How much am I spending to acquire customers? If you don't have how many customers you acquired, you can't even get started. So, so I think, back in the day when people would think about unit economics, they would think about it, but they'd have a different unit, but the unit would be the store. And here, I think the reason that the world has changed is, for one, all these companies, they do have the great CRM systems. A lot more of their purchase behavior is very easily trackable, especially when we move to all these direct-to-consumer businesses. Then we have perfect trackability.
Data's there,
and so we can actually carry out the analysis. But even there, we'll run into problems if the companies don't disclose any data in their SEC filings. So even if they are a direct-to-consumer brand, we can only run with whatever we're able to find. And so if they don't provide anything in their SEC filings, then, we can have this great framework, but we don't have any data to apply it to. I think we're kind of hitting that sweet spot where, for one, we do have, they have the availability and everyone realizes how important this is. And so the companies, whether it's that they feel they have a compulsion to disclose it because if they don't, they're going to get hammered by their investors, or they just want to show off.
Steve or you or whoever,
So I think whatever the reason might be, that's I'll leave that to people better than me. They're just disclosing this stuff a lot more frequently than before, and so now we can finally do this with a lot more regularity than we ever could before.
I was going to say, it's interesting. I spent a few years at Neiman Marcus. One of the things that was just a huge advantage to your point was we were able to uniquely identify a very high percentage of our customers' transactions because we had such high spending on our own credit card, and we had a very big direct business, and we had a lot of clienteling through our point of sale system. And so our ability to do this kind of analysis was much greater than your typical retailer. So I almost kind of, not that I didn't realize that was something unique, but I got pretty well versed in some of these techniques. And when I started to work more with these digitally native brands, some of this way of thinking was just something I was pretty comfortable with. But I think, there hasn't been a lot of ability from the outside to look in.
Who's the gold standard for this, using your models, whether it's your academic models or the models in your Theta or your private businesses? What's the gold standard in all this? When I think of retailers, I think of someone like a Costco who, license plates due to the membership every single transaction, and that's more common. That's baked into their business. But from your clients, when they use it, who's gold standard?
Gold standard in terms of the ability to track customers and run the models. Usually it's shooting fish in a barrel with subscription firms.
Right.
They're obviously, if you're a subscriber, we know who you are. We know when we know when you were acquired, but we know exactly when you churned too. And that's really convenient. So usually in a setting like that, it's really easy. So we have this great trackability from a modeling perspective. Usually there's not a whole lot of variation in spend and purchase frequency. We need to worry about, the concept of a major holiday period or some other spike because of a big promotion that's run. Those just don't happen as frequently because you just kind of get your thing once a month or whatever it is. So that simplifies the problem greatly. And actually, Steve, you mentioned Blue Apron. I think it was a good example. Not quite perfectly subscription based, but enough of the subscription flavor that the models work really, really well. And then obviously the other component to it is if we had all that data using the full granular transaction log, even better. So a lot of the work at Theta, thankfully, these targets still put the full transaction log in the data room. Basically, the data room is where all the data resides, traditional financials and otherwise. So there we can build an even more granular model because we have even more granular transactional behavior data.
So let's maybe, we talked about Blue Apron a little bit, but there have been quite a few companies that have been in the news lately, either because they've filed their IPOs or their S1s for an IPO, like Warby Parker and Allbirds, or Peloton, I know, has gotten a lot of press recently. Could you maybe talk about some of those companies that you've been following and how would you apply this lens to thinking about their valuation and prospects, and any observations you might have that our listeners might find interesting?
Yeah, so maybe just about Warby Parker, because I think they had dropped their S1 really recently, just within the past week or two. So they're kind of they're the poster child of the direct-to-consumer, digitally native vertical brands business.
And born out of Wharton as well, right? So there's a real connection there for you.
Yeah, that's right.
Professionally, right?
Yeah, they're we've seen and met. Yeah, I believe Pete's spoken with with the founders. So definite. And thankfully, they've built a really nice business. So they're not profitable yet, but at least the economics actually look pretty good. So we're in the process of finalizing this really deep dive that we did into them specifically. The way that we carried it out is basically the same way we carry out any analysis, and that is that kind of step number one is to first do that same old exercise of saying, well, how much are they spending to bring customers in, and then how much are they getting after they've been acquired? And then you're kind of looking at the volume of customers that they're able to bring in over time, and see how that's been changing. And the nice thing here is, Warby, they provided so much data in their filing that we could really feel pretty confident about our conclusions. I'd say one of the bottom line figures that we found is when they spend money to acquire customers, they earn a rate of return of about 300% on that customer. So, that's kind of comparing the acquisition spend, which we estimated in 2020 to be on the order of $55. Then they're making back a whole bunch of money in contribution profit terms after acquisition. Yeah, so they're not profitable, but the reason why is, they're still in growth mode. They still need to acquire a whole bunch more customers. And when we do this unit economic calculation, we're not baking in all the fixed cost overhead that is required to kind of stand up the business and bring those customers in. So what it would suggest is that they would have a nice, clear path to profitability as long as they're able to kind of maintain this level of unit economic performance, for the next few million customers that they acquire.
How would your model flex if they decided they were going to use all that fresh ammunition and start buying competitors in their space? Because it feels like there's going to be consolidation in that space to me.
Buying competitors, it would be helpful to have these same sort of measures for the competitors. One thing we could do is we can basically change our assumptions about how much they're going to spend to acquire customers, and we can change our assumptions about how much repeat business that we'd expect from those customers. So that would be kind of very easy to do mechanically speaking, but we just really want to be mindful of what is reality. And are those customers that they would be bringing in through an acquisition or otherwise, are they going to be fundamentally really different or not? So having some sort of empirical data that can help us pin that down, we'd really want to make sure to kind of do that exercise before really kind of pounding our fists on the table.
Two questions follow up. One is, a lot of folks have been talking about rent as the new cost of customer acquisition. And as you well know, and I'm sure most of our listeners know, a lot of these brands that thought they could grow and raise a lot of capital on the premise they didn't need stores are turning out, and Warby Parker is a great example, to be opening quite a lot of stores. What do you think, I guess, in general, that idea that rent is kind of this new cost of customer acquisition, and how would you factor, or do you factor that line of thinking into this analysis at all?
Yeah, I believe it was Jason Goldenberg who he said that a store is basically like a giant billboard that can kind of bring the customers in. And certainly when we think about Warby Parker in particular, if someone goes into a Warby Parker store, they can try on the glasses over there. They may not need the direct try-on home kit, which can be more expensive. So even just kind of doing that comparison of acquisition through one channel versus the other, you can very clearly see, obviously there's rent for the store, but assuming that you have a sufficient number of people who are coming in for the orders, like the customer acquisition spend will certainly be just lower through stores than not. I think the tricky part is that it's hard to open your own stores. Obviously, if you spend $1 million or $10 million on Facebook ads, assuming that you're able to bring in good quality customers, you can just scale much more quickly. Finding great locations for stores is not trivial. So it's just not something you can scale quite as quickly as purely online channels. So I think, that is part of the trade. But obviously, the other part of the trade, I guess, is what we've seen with COVID. That I think this was kind of a black swan type of event that no one could have ever really predicted. But they got hit pretty hard because, as you kind of alluded to, they're actually. You would think I had thought that they were a direct business that had some stores, but actually they're more like a store business that has some direct. That they got something like 2/3 of the revenue through stores before the pandemic, and so they really got walloped by COVID. But you could see from their quarterlies that things are looking a lot better, especially in the most recent quarter or two. So. Hopefully that's a sign that things are starting to normalize for them.
I mean, Warby Parker is a really interesting company. I don't know how much we can generalize to some other companies, but the second question I had as you try to think about long-term value is I worked with one brand a bunch of years ago where my concern was that early on they basically found the perfect fit kind of customer for them without having to spend a lot of money on customer acquisition. And then to get to that next stage of growth, they basically were more going to have to go find customers. And because they were mostly digital, they were paying more and more to acquire a customer. And the customers they were adding at the margin tended to be less valuable or more price sensitive, or they just didn't fit. They were just kind of like going around the edges of customers that were a good fit for their model. And so my question is, and I'll just use the Warby Parker example. How do you know what the limit is of the sort of customer that's likely to shop at Warby Parker? And is there this risk that decay rate, I guess, for lack of a better term, or the maturity curve is beyond your current horizon, and therefore that might cause you to overvalue the company? Does that question make any sense?
Yeah, it does. And honestly, as you're kind of saying pretty directly, it applies both to the stores and to the direct business. For the direct business, oftentimes the canary in the coal mine is the CAC starts creeping up, that you're just having to work harder to bring those customers in. And so, basically the thermometer there is, amount of marketing spend per customer acquired is just higher. But the fact that you have to work that hard oftentimes implies like a double negative, that we found that there's often a negative relationship between how valuable customers are after acquisition and how much you had to spend to bring them in. So when CAC tends to move up, the value of the customers often also tends to move down. Right. Because again, if you're working so hard, maybe they don't want to be there. So, yeah. So for the direct business, I think that would be the canary in the coal mine. I think the analog for in the store setting, might be a little bit harder to identify. It could be some measure of foot traffic, for example. But I got to admit, I'm on more comfortable footing, on the direct side of things. The other thing that could be a source of data, because again, it's kind of falling outside the range of the data, because it's saying like, at what point does the quality of your customers in the future, at what point will it decline in some, discontinuous way? I think very smart survey work can help give you a hint of it, but surveys come with their own issues, so you really wouldn't want to lean too hard on them to help answer that question. But I think that could be another thing. In the case of Warby in particular, they said that they acquired about 6.6 million customers since their acquisition. So that gives us a pretty clear number, at least kind of from a gut check perspective. Like, we know how many people need glasses. And so, we kind of can compare, some measure of like the overall market subset it down to the people who we think would be a better fit for Warby, no pun intended, and then just look at that 6.6 million and say, huh.
I like the way you framed that question, Dan.
Look, I can see this. I see where this is going. There we go. Okay, I can do this all day long.
Oh, man.
All right, last kind of set of questions. I'm going to do a rapid fire round with you. Rapid fire. I'm going to throw out some companies and an idea, and you give me your feedback based on how you think about them in their model. I think of Chewy, for example. Results, okay, big tailwind. And when they don't just acquire a customer, they acquire a pet, which is like an annuity. How do you think about Chewy?
Yeah, in general, we've found that pet businesses, for whatever reason, tend to be better from a unit economic perspective. I think because they like to be really variety seeking themselves, but for their pets, they like everything to be the same. So you have these stories of people who, they'll say, we only bought our dog one type of food until they died. Literally just kept the food the same the entire time. Like we would never do that as humans.
Maybe the food.
It's like that Larson commercial. Okay, Canada Goose shifting from wholesale to direct to consumer, big ticket item. Any thoughts on a business like that?
In general, if you have a really, really great wholesale business, I think pivoting to direct to cut out the middleman can make sense but I think the key is that you have a lot of market power over the middlemen. If you do, then I think you have the leverage over them to be able to wean the portfolio and not get killed in the process. So I don't know exactly how the power dynamic is between the two, but I feel like that would kind of drive whether I think it's a good idea or not.
Okay, Curate, which is HSN, QVC. A lot of their customer acquisition comes from the television. What do you think of that kind of base business? Yeah,
they'll need to evolve. So, I know they used to do a lot just purely over the phone. So they've done one evolution, but I think they'll need to do another big one.
Okay, last one. RH, great numbers out recently from RH, which I think Steve might have predicted wasn't going to be so strong, but neither was I. They're just knocking the cover off the ball. Their customer acquisition costs, look at their stores. They're massive. They're a huge investment. I guess it works out for them, yeah?
Yeah. I mean, certainly to the extent that we see people being comfortable going back into stores, you'd have to imagine that at least their share of the category could improve. I think there are concerns about people having pulled forward a lot of demand because of COVID to get all that stuff into their house, and they're buying these new homes. And if that slows down, then but then it's going to slow down for the whole category.
So can I ask about one more kind of in that regard is Peloton? Because Peloton seems to me to be a brand that, number one, I'm sure most people, it's got a subscription part to it, but from the equipment perspective, most people aren't going to have 2 or 3 Pelotons, right? So we have this period where people are working out from home, maybe some extra cash because of stimulus or because they're not going out. And we see this big surge in Peloton sales. And now it seems like it's a little bit dicier proposition. Any comments on their business? They're certainly getting a lot of news lately.
Yeah, to me, the big question with them is, how big the applicable market is. How many people are going to be adopting over the next few years? And some of the analyst forecasts for how many people are going to adopt over the next 10 years are insane. I mean, it's like predictions of 50 million new customer adoptions. Like, we're just not going to see that. So, they'd have to mark the bike down like crazy, I think, to be able to get enough people in the door. But if they mark the bike down, then the unit economics get a lot worse. Not only because they're going to make less profit off the hardware sale, which they're making a lot of their CLV is coming from profit off the equipment, but also it implies that they're going to bring in these more marginal, shifty customers that are going to be more prone to leaving. So right now they have this insanely low churn rate. As soon as they start really, really lowering the price, you got to imagine that their churn is going to have to move up. Yeah, so exactly how that plays out, I think that to me is one of the big questions.
So interesting, and I love that term, shifty customers. I'm going to use that.
I call them promiscuous shoppers.
Like a loss prevention episode. Well, listen, Dan, we love to have guests that help our listeners see the future. I think we've seen the future of this model. I mean, as you say, it's hard to imagine any other way as we think about looking at companies in the future. So thanks so much for joining us and sharing both your background, your approach, and and some quick insights as an ad hoc. And it was really a treat to listen and learn more about your process and models. So thank you.
Well, thank you for thinking of me. So yeah, great to be on the show. And yeah, if anyone has any questions, I'm pretty active on social media, LinkedIn and Twitter. So definitely, please don't be a stranger.
If you like what you heard, please follow us on Apple, Spotify, Amazon Music, or your favorite podcast platforms, so you can catch up with all our great interviews. Subscribe, so that just automatically shows up. Tell your friends, and also in new insights and new episodes will show up every week. So tell your friends, because that will help us share the word, the good wisdom. Now, be sure and check us out on our new YouTube channel. Not so new anymore. We got a couple episodes up there, and just look for Remarkable Retail.
And I'm Steve Dennis. You can check out more of my work at my website, stephenpdennis.com, or on Forbes, or on Twitter. And please check out my second edition of my book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption, available just about everywhere books are sold.
And I'm Michael LeBlanc, producer and host of the Voice of Retail podcast and a bunch of other stuff. You can find me on LinkedIn, learn about me on meleblanc.co. All right, Steve, great episode. Look forward to chatting again next week. Be safe and have a great rest of your day.
Same to you.